So welcome to our panel discussion now. I wanted to introduce my panel members, and I will ask each one of them to introduce themselves in more detail. And maybe, I don't know if I can see all of you, so if you want to come closer to the center, shall I move? Maybe let me move over there, because then I can see the whole audience here. Perfect. So our discussion today is about the fintech capital sector. But before we go into the debate, I would like you all to introduce yourselves. So Andy, if we can start with you, please.
I'm Andy Creek. I have been, is that okay? I've been doing startups for 25 years, still going. And when I get to my bits, cocked up most things along the way, but not yet lost shareholder value. Currently doing a natural capital platform for asset managers.
Alex?
And I'm Alexander Luca. Not quite as long as you. I'm a
grey hair, not grey hair. Looking good.
But I'm that will come with time. I'm a first-time founder this year, but my primary experience is as an investor in fintech, broadly speaking, through private equity with a focus on specialty lending. And investment banking prior to that, but have been in the sort of fintech, both in the US and UK area for a long time.
Fantastic, Alex. And Chris?
I'm Chris Hill, a fintech partner at the law firm Fox Williams. I've never seen my face that big before. It was really quite alarming. A lot of the work that I do is the legal work for startups and scale-ups in fintech as they seek to grow. So I end up encountering a lot of the good, the bad and the ugly of what goes on. But over the 10 plus years that I've been doing that, mostly in fintech, we've seen a lot of development in the ecosystem, a lot of development in the industry and the business models that happen. So the reforms that we're talking about now are sort of very much an encouraging sign, I think.
That's great, Chris. So we've got on the panel, we've got fantastic entrepreneurs, investors, and we have got a top lawyer with Chris. So what we will do now in the next 40 minutes is asking a few questions which I have prepared for all three of you, and then we will open up to all of you where you can ask your questions for our panel members. So be prepared to share and ask anything you like them to answer as well. So if I can start out, Chris, with you about the regulatory reforms we talked about in the film. We had the Mansion House speech of our Chancellor of the Exchequer. We had the new budget by the new government. So how do you assess from a legal regulatory perspective the current environment?
All in all, really quite positive. The Mansion House speech in particular, and some other bits and pieces that came out about the same time, things like the National Payments Vision, are, I think, very encouraging for the fintech industry and basically anyone that's trying to innovate in tech and particularly in financial services. In the film, I was talking about the fact that the regulators here have, well, I think I said the regulator has a competition mandate, which is not the case everywhere. Actually, when you look at how the Mansion House speech and the National Payments Vision, for instance, are constructed, you've got, we've actually got a number of regulators. So you've got the FCA, of course, PRA, Bank of England, Payment Systems Regulator, and what these sort of recent announcements have done, amongst other things, is to try and reduce regulatory congestion. That's something that in the innovation space people really struggle with, is the number of, I think the quote was, the sort of well-intended initiatives that are fine on their own, but when you put them together with all the other things that are going on, in some areas it's been really quite difficult for payments companies, is one example, for them to deal with, to ingest, navigate and operationalize the plethora of different regulatory initiatives that there are. So of the early stage capital that is so crucial to the innovation in this country. You look at any of the big names in fintech now, they all started with those types of investments, with those types of tax breaks, and you have to ask yourself if those tax breaks hadn't been available, would they've got off the ground in the same way? And I think it's doubtful they would. So to see those tax reliefs being extended for such a long period of time, it gives the market certainty, it gives people an ability to kind of bed in and know that they can invest in those companies and have a good chance to see a return, or at least to see those protections still being in place. So that's very good. Then, last but not least, the capital markets reforms themselves, as Julia Hoggett was saying, those are really big changes, the biggest change in 40 years. She mentioned very briefly the dual share structure. If you don't know the detail of that, it's essentially saying that founders can retain more control over shares after IPO, which in turn means that as they get close to IPO, they're thinking, if I might want to retain more control after going public, I don't feel the need to go abroad in the same way. So the later stages of the development up to IPO, they're more likely to stay here rather than feel that the need to go over abroad with all the hassle and the disruption and growth curtailment that necessarily involves.
That's very good points, Chris. And maybe one other point for any of those of some of you maybe who are part of listed companies. When you're part of a listed company board, it's now easier for you to acquire fintech companies, private companies, because the acquisition of private companies is made easier and doesn't take as much time anymore as it was before, which means for you as fintech company founders, the exit route, having a dual track process, if you pursue those strategies of either IPO or dual or private exit, is easier because the private exit route is easier manageable for listed companies. So many benefits, as Chris pointed out. Let me go to Andy. Andy, you are a serial entrepreneur, successfully sold businesses, run business in the past, and now CEO and founder of Kana Earth. Andy, what are your tips for many founders in the room? How did you scale up? How did you grow your business in the past? And what tips can you share with everybody else who wants to almost do it as you did it, very successfully?
Thank you. So I think the first point I'll take here is I think 99% of the entrepreneurs I've met want other entrepreneurs to be successful. And I think that's a really important point where everybody just, hey guys, don't make the same cock-ups I did. So here is a list of things that I would suggest, and you guys have probably done it again, and I just hope you haven't done these cock-ups, and I'm going to try and hopefully provide some insight that says please don't. So who am I? What's the right do I have to sit here and say this? I've done 5 startups, 3 exits, hopefully 4th next year. Part of a unicorn thing which is cool, but I have hired the wrong people, I have priced products badly, I've created the wrong incentive structures, I've got the wrong investors, and I've educated hundreds of VCs for no reason. And I've got the wrong advisors, the wrong prospects. So all on that journey, if you like, I've been meandering into the wrong places, hopefully learning each time. And just a couple of points about Kana as well, because Kana Earth it's the natural capital platform for asset managers. And natural capital, this is this new 1 trillion sector that's arriving. It's something that's really going to make countries trade, nature with each other, and it's quite frankly every business on earth is probably going to change what they do, and every government's going to change their thinking. However, in natural capital, governments aren't playing ball. Corporates have gone to ground, and you have a situation right now where the Guardian newspaper loves, printing stuff about, hey, this has gone wrong and that's gone wrong. So why am I doing this again? Well, here's 5 things. Hopefully they're useful, and hopefully they'll give you some insight. So my thinking, number 1, start early. And start early is the first 12 months of any startup should be on somebody else's paycheck. Somebody else should be paying for your salary while you're thinking about what you're doing next. And what you're doing there is my point, get interesting, get your network wider, get your data flows, and then allows you to have more conversations. You've got to get out of your current sector to talk to other people. And in that whole process, and I'm a great believer in testing your proposition. Each of the times I've done this, you test your proposition with people you speak to. I think the IP of these ideas is sometimes challenging. We think, I don't want to tell anybody. I'd like people thinking and challenging me along the way. And the financial model for me, you always do that really early, and it changes. Keep your version history, it changes. You change your assumption, you change your thinking, you change how you price. And the last one is, I think, I've always tried to get my team early. My team doesn't necessarily know they're joining, but I always try and get who my team is in a quite an early stage. So my first one, start early. The second one is, when you do start your business, there's a real difference between employees and founders. And you really do need to work out what's a founder and what's an employee, because they behave completely differently. And when it gets tough, again, and that team, your team member problems are your problems, especially as you've got such a wide scope in early stages. People are totally outside your comfort zone, and you need to be comfortable being uncomfortable, but your team may not be. And have horizons. Have this idea that you get to a horizon 1, and then you can go to horizon 2 rather than just looking as a big climb. And always have an exit. It's always good to say, this is what we're doing, after horizon 3, this is the way we're going to be doing next. So the second one then is start your business, but it feels in a different way. 3, learning capital is a skill. I'll look at Alex here. Raising capital is a skill, and you really do need to be very, very good at it. EIS raising in the UK, you need to work out what an EIS investor looks like. And I tell you what, 3 questions, you find yes or no, whether they're going to be, it's a different conversation that you're building up with your network of people getting started. But EIS investors are so useful because they can help you, they can introduce you. At Kana, we've got 14, and I think without fail, 12 of them have just challenged me, have given me intros. They are so useful along the way. And I think, never fill in a VC form online. Never approach a VC online. Always go and talk to them. Always get an introduction to them. I've wasted so much time on that one. And I think that's sort of raising capital. It's a skill. Go learn it. Go talk to people that are good at it. 4, get awesome at selling. The number of people I've invested into about 10 businesses actively now at the moment. And the number of times you sit there with the founders going, crap, I can sell your business better than you can. I will invest in it, but my goodness. Get really good at selling your market, get really good at selling your team, your proposition and your business. And that is not a deck, it's getting that ability and then get really, really good at closing. And the number of people I can say that have great sales meetings, as a founder, you have to be good at closing and you have to price your time. So do not chase things that you're not closing. Your time is worth so valuable. So that piece on there, get awesome at selling. As 4 books I've got, I just go back to again, the Psychology of Persuasion, On Selling, How to Win Friends and Influence People, and Crossing the Chasm. And on Crossing the Chasm, get the latest version, because the earlier versions, the examples they use for successes, some of them have gone bust. So on that one, on the books, they're my big 4 read. And that final one, that video pitch. When you video yourself, watch yourself without sound, you listen to yourself without video, and then read your transcript. And it's so interesting when you look at this, the ums, the ahs, the pauses, and so on, you don't get your message across. So that one is just get awesome at selling. As a founder, you've got to be good at that. 5, and final. Get good and stay good. Know what makes you tick. The number of times I've sat here and gone, why the hell am I doing this? But what makes you tick? What makes you strong? What are your strong points? But really work out where's your not strong points, and how do you cater for that? How do you fill that and compensate that with people? And I think, if you like, get good and stay good. The final point, you guys probably all know this, but Federer has this wonderful expression. Roger Federer has won, let me get this straight, 80%, just over 80% of his 1,526 singles games. but he's only won 54% of the points. So 46% of those points went past him, he missed the ball, he didn't land it, and yet he got up and got the next point. And that's the way you get your 80%. And that one there is that sort of mindset and focus. Now, the final point is get good and stay good. Thank you.
Fantastic recommendations and tips. And what I think we should do, Andy, afterwards, we should publish this as a blog post, because this is super relevant.
And it goes back to, I think most entrepreneurs want other entrepreneurs to be successful.
Yes.
You know, that's just, the more learning you provide in the system.
Yes, exactly. So we published that in a Fintech Circle blog post, so you can all read it afterwards as well, and of course get the contact details to Andy and learn about Kana Earth. Now I wanted to ask Alex. Alex is co-founder of Factor Evo, also previous investor, and an expert both sides of the Atlantic in terms of fundraising. So can you tell us and share your thoughts in terms of fundraising environments, both in the US, both in Europe, in the UK? What are the differences? What are the commonalities? You know, what have you experienced?
Absolutely. So, as you've mentioned, I'm a co-founder of Factor Evo. We are a fintech company focused on the technology, the enterprise software for specialty lenders, primarily factoring companies, both in the UK and the US, with a focus on transportation and logistics. So a lot of commonality between the two areas, and there's a lot of commonality in the capital raising, again, in those two geographies. I can say that there's really three major differences, I would say. Four being the regulatory structure, but I think that's been adequately covered already. But the three are size, structure, and focus. So let me go through, and the easiest one obviously is size. By way of background, the US and the UK, obviously the US is much bigger. The US GDP is about 7 times that of the UK. If everyone in the audience had to take a guess, let's say in the first quarter, the US raised $45 billion in VC capital. That's capital for startups coming from venture capital, either funds, investors, angels, etc. $45 billion in one quarter. Is the UK, 1/7 of that is about $6 billion. Is the UK above $6 billion or lower than $6 billion? Who thinks it's higher? I can count the number of hands on one hand. You're optimistic, but wrong. It's less than 4 billion, 3.9 billion. So less than 1/11 of the US number. Now that sounds bad, but having said that, the other two items, structure and focus, alleviate a lot of that. So in my experience, the UK is primarily focused on fintechs, right? So if you take a look at the US, if you're at capital raising in the US, which we are currently, everyone is talking about AI. And we actually have an AI platform and we can discuss that. But if you are not doing anything in AI, no one in the US is looking at you today. If you go back 3 or 4 years, everything was social media. Nothing to do with fintech, but you know, so they go through these different, I guess, you know, cycles where different parts of venture capital will be accentuated. Today it's AI, but in the US you have climate tech, you have fintech, again, social media, the whole gamut. So that 45 billion, although in any one quarter will be focused, over the course of time is highly fragmented among different sectors. The UK tends to be highly focused on fintech, reg tech as well, but I lump those two together. So that alleviates and actually makes the fintech focus in the UK, if you are a fintech company, extremely good. In the US, you generally have to go San Francisco, Boston, Miami, Austin. There's 3 or 4 other hubs. Here it's London, Cambridge, Oxford. Very easy. You can do it all in one day. And ideally, you just come here and sit down with yourself and you're done. The third factor, structure. The US, again, significantly higher amounts of capital. To get seed, to get angels is very difficult. Most of that capital, because it is large, tends to go into A, B, C, D rounds, and there are. Effectively disintermediating some of the public markets. So I think everyone has seen in the US and the UK as well. I mean, Revolut is a poster child here. You generally see companies that would have gone the IPO route 20 years ago, stay private, and access much deeper rounds of private capital. Those D, E, F, etc. It's a virtual, you can get up to, I think, a Z round these days. But you can stay private for much longer and avoid the scrutiny and the regulatory aspect that IPO and public markets require on both sides of the Atlantic. Having said that, the UK, because of the EIS and those schemes, is significantly easier to access in terms of angel investors, pre-seed and seed rounds. The smaller rounds that, a lot of the larger VC companies in the US will generally not look at anything under 5 million. So if you're raising a seed round of 1 million, 2 million, it's difficult to get an audience. The angels are there, but it's much harder to find in the US. They're much more fragmented. So it's really a question of networking and finding out who you know. In the UK, that cluster, that universe, and Andy, I completely support your point. People here want to see you succeed. The universe is significantly smaller, easier to access, and you can get to see the people that you need at the lower funding rounds much easier. There is one other aspect, which is, and it kind of gets into the legal aspect. In the US, especially the early funding rounds, the standard tends to be the SAFE, which is similar to the ASA here. Yeah. It's structured as a forward sale of equity, which for early stage companies, it basically kicks off the valuation discussion into the next round or further down. In the US, it's the Y Combinator documentation, they've made it free, it's become the standard, but it is significantly more flexible than the than the UK version, the ASA, which tends to require, to be also EIS compliant, I believe, that you issue equity in less than 6 months. So the funding rounds here, for whatever reason, the structure is they need to be much faster than in the US.
Yes, that's great, Alex. Thank you.
Those are the sort of the three primary differences between the two markets.
Fantastic overview. Fantastic. Very, very useful. I think for everybody to understand, those perspectives across both the US and the UK fundraising environments. So I can see we've got questions coming in on Slido. So as you know, you can all ask questions on Slido directly. You can upvote and downvote, the most relevant questions to you. So we start with the ones on top as the priority ones. And so I read it out. So the first one is, can the UK realistically hold its position? And if so, what must it do to ensure it continues to hold its position of strength? I can start, and then we can, please feel free to comment. One reason why we did the film, which you saw just before Fintech Capital London, is because, and I guess I'm very objective because I'm born in Vienna. I'm originally from Austria. I came to London 26 years ago because London was the place to be when we wanted to work in finance. And 26 years later, I still think that's the case actually, although we had issues and difficulties over the last 10 years. But I think, and I talked about this in a workshop we just had before, that there are certain framework requirements, tax benefits for investors, which we don't find anywhere else worldwide. such as SCS, EAS, no capital gains tax for investors, no inheritance tax to pay once you invest in private companies, so hugely beneficial. I think the issue which we have is currently for larger companies listed at the stock exchange where there's not enough liquidity. And I've met companies listed on AIM, and literally their valuation is less than their annual revenues. Those are companies which are in a difficult position because they are thinking, what should they do? Should they delist, go private? Should they, how should they raise more capital, raise more awareness, for them? And I think the new capital markets reforms are addressing all those points. And of course, what we need most is liquidity. We need, the pension funds investing more in UK equities, because when we've got a more capital liquid environment at the top end, it trickles down to the scale-ups, it trickles down to VCs, PEs who can exit portfolios, can reinvest the money they made, and so the whole market is more liquid. So I think that's, from my perspective, one of the key things which we're hoping that the capital markets reforms will result in, and so very positive, hopefully. Maybe question number 2, London is still in a good shape and holding top spot in the space, but how have other top 5 markets changed in the last 5 to 10 years? So, you talked about America. Andy or Chris, do you want to talk about any other markets or any other European markets? I can just share one anecdote about Switzerland, if you like. I remember I was at a Swiss conference 6 years ago, and we had, at that time, we had FINMA, which is the regulator like the FCA here in the UK, and at that time, FINMA was not as supportive to fintech companies as it is now. And I remember one fintech startup CEO approached me and said what he should do in order to speak to the regulator in Switzerland, because they were not open to engage with the fintech sector. And of course, this has changed rapidly now, where the regulators, I think, across Europe have realized that if we do not support our local startups, they just move. There are no borders. Startups can move across Europe. Many startups come to London to raise capital here. Many startups move to the States to get scale-up rounds or do an IPO. But of course, we don't want that. Ideally, we want companies, we want them to stay here in Europe, in the UK. But I think, as an entrepreneur, we can move easily. If we don't find that the ecosystem is good for our needs. And so that's, I think, one comment here in terms of what I've seen in Europe. Any other comments you want to make?
I can speak to this firsthand as well. So Factor Evo, my co-founders, as you know, I'm based in London. One of them is in Miami. Another one is partially in London, partially in Germany. So we are very much a global company, despite having a UK and US focus. And you're absolutely right. The regulatory, the tax regime, everything goes into it. One of the companies that we've looked at in terms of this is how you scale up as a possible model is Stripe. A massive payments company based in Ireland. Why is it based in Ireland? Because of tax. Ireland has, and this is outside the UK and the US, an outsized presence in treasury, finance, because of its tax system. Really drives international companies to be based there as their European kind of threshold, if you will. So you have in Dublin an overwhelming amount of finance, treasury, and some technology people. You have that nexus of knowledge that really wouldn't be there otherwise. So the fact that tax and regulatory regimes do impact cannot be overstated.
In some ways, I think that's one of the advantages that London has. And one of the things I did mention earlier was this FISMA model that we've got here, where in Europe, a lot of the legislation is decided at European level, so it comes down as a directive and then it's implemented in each country as sort of national regulations. There are some things like GDPR that are regulation from the start, so they have directives that they apply across everything. One of the things that the Tory government announced a bit over a year ago, I think, was the Edinburgh reforms, where they said that they wanted to move to what they call a full FSMA model, where you have the government passing primary legislation that sets the direction, but a lot of the detailed rules are actually set by the regulators, and therefore on a much more agile basis. And as long as the regulators are staying within the direction that's set at the primary level, they're okay to move. Now it sounds like a really technocratic thing, but actually makes a huge difference when you're in fintech, because payments, one example, the rules were set at a very detailed level, at a European level. It takes years and years to change them. So by the time PSD2 came into effect, there were some aspects of it that were already almost obsolete because it had taken so long to get it in place. If you move to a model where a regulator is able to engage with industry and to tweak the rules to suit those new business models that innovators are coming up with, almost probably not as they happen, but in a much quicker timescale than you manage with a full European Parliament implementation, you're going to have a more nimble, agile regulatory regime that is better adapted at any given moment to what's actually happening in the market, which is, I think, is a good thing for innovators and consumers as well. To your point there about to the question about other markets, and I've seen some interesting things happening in France. I think again that's partially tax-based. There's a lot of good stuff comes out of the US continually, and we see a lot of stuff coming. As lawyers, we see a lot of American firms expanding into the UK, and then there are the Irish firms that are largely there because of the tax. None of them has quite the same combination that you have in the UK and London of having the financial, the creative, and the political centres in pretty much one place. That's a big advantage, I think.
I agree.
Good. Yes, please, Andy.
I do a completely different angle to all of this, which is people. And what makes somebody sitting here, assuming being an entrepreneur, is a spark. Spark happens. And you can get somebody who's early 20s, spark happens, they go off and do things. But it tends to, certainly in my experience, you need spark and financial security. If you don't have the financial security, then the spark sometimes just doesn't work. And the way you get financial security is being part of a successful startup. Because you've got your shares, and if a good startup should be EMIing the shares around and getting all those bonus things in. So what breeds good startups is people from other startups being successful. So I'm just trying to count how many millionaires I've made along the way, if you like. And my sort of ambition is they all go and do startups. How do we get them to be successful? And I think that is the biggest thing. You've got tax, and I take all that points, I'm taking away, but it's people, spark happens, financial security, good enough network, ideas get green, and then it happens. Of course, a lot of, again, failure, spark goes, try again, another one. And that's the people one. And I think that's what London has. It is a good bunch of people. You can get 8 to 10 really good people in an environment doing some amazing stuff. And if you can just give them a bit of financial security and a bit of investment, off they go and do great things.
The room, but I guess we could definitely say that our fees were high. We charged a lot for the benefit of our advice, for the benefit of our products and access to those investment products. I think what Fintech did to the asset management sector, it challenged the fee model, and asked and provided, I think, a reason and rationale for investors to say, why should I pay 300 basis points in my total expense ratio to a fund if I can invest in a passive fund for 75 bips, 100 bips. So to justify your fees, and fintech, because fintech companies challenged the status quo in terms of how to provide asset allocation models, how to provide investment portfolios to their customers, are able to offer these investment portfolios, and no matter which tax wrapper, it might be a pension, pension B is one example, which is a very good fintech solution to save for your pensions. It might be, so many other, wealth tech platforms, which I think revolutionize, in fact, the asset management sector. So I'm very positive about how fintech is changing, improving access to attractive investment opportunities at lower costs, which were not there before. And so I think a very, very positive impact. Anything? Yes.
I'll just go too, because I think, hey, I'm in asset management, fintech, so of course I'm biased on this.
Yes.
I think there's a lot more to go. I think active fund management has got a real challenge.
Yes.
And a real challenge over a 5 to 10 year period of time. And lazy money hasn't been sorted yet. There's a lot of money that's not doing things because of us. We don't do enough with our money. And I think it's a lot more to come. Watch this space the next 5 years. Active managers really probably need to justify their existence a lot more. But actually, those models, when they start turning up, I still think there's a lot to change.
Yes. And of course, Andy, co-founder of Co-Funds, you are the example of revolutionizing the asset management space with Co-Funds as well.
Yeah, and I think this goes back to the fact that you just, we haven't cured, you guys are probably going to know the stats, there is so much lazy money in the UK. Money not doing things, pensions, we all put money in pensions and then go, hey, wonder what that's doing. When do people get in their lives and consolidate their pensions, work out their ISA allowances across this, do the generational thing. And those are the sort of things I think tech has got such a big role to play in. I'm not seeing the wows yet that are really going, yeah, that's going to make a difference.
Yeah, good.
I definitely agree with that in terms of, I think if you look at it historically, asset management over the past 20 years has become somewhat commoditized. It's been driven by algorithms, and it's not algorithms in terms of robo trading. It's algorithms in terms of going from active to passive management, right? Doing the indexing, doing the stuff that, if I was running $100 million, 20 years ago, I would need 2 portfolio managers. Today, I don't think I need 1. I just need a computer to track the index, right? So in that context, historically, it's driven into a more algorithm index passive investment style. Going forward, though, I think the innovation in fintech is primarily around delivery channels and customizing a lot of those algorithms. So, if I am a middle-aged man, with a certain pension pot and I want to retire by X year, I can have my asset management strategy without ever talking to anyone. And that's the benefits of AI and all of that mixed in.
It's an interesting example of where the tech and the regulation intersect. Because yes, you can do an awful lot more with tech now and have it completely passive, but how does that interact with consumer duty? And all the stuff that consumer duty puts on you. And at first blush, consumer duty makes it very, very difficult for asset managers of anything less than really quite big portfolios to make money off it because of all the stuff they've got to do. But then I've seen a handful of really quite compelling fintech solutions that come in and help to solve that consumer duty problem by using tech to streamline and make far more efficient the process that was previously taking humans a long, long time to do, and therefore making it more efficient. Everybody benefits because you have something that is more automated but is still meeting those consumer protection requirements as well.
Yeah.
It's quite a powerful thing, I think.
Yes, good point. Okay, so we've got one more question and then I've got a surprise for you. So the last one, let's take in the top one on this list, which is, can London, the UK, ever create the equivalent of Silicon Valley? So who wants to go first? Andy, do you want to go first?
Yeah, no.
Why not?
Right, and I go back to, I think it's, I've been flippant. We're too afraid of failure in the UK. And that's the risk and their ability to fail and go, I learned from that, let's go with that again. And I think we need to find some safety mechanism to allow people to fail, organizations to fail, and they learn and go again. And I think that's the piece that Silicon Valley's done well. And I don't think we're there yet.
There's a big cultural differences there, and well, you'll be able to speak to this by my style, but the hire and fire structures that you have in America. That it's something that's embedded in just working life. Is actually you could be gone at any moment. You're not used to that security. People get used to that and therefore are less afraid of the concept of it. Some of the best entrepreneurs that I've seen, that I've ever dealt with, have been people who have been smart enough to understand the risk and brave enough to go on with it anyway. And they quantify it and they move on. And occasionally they do fail, but then they, as you say, they pick themselves up and start again.
Absolutely. I think there is a culture of failing fast in the US. And to your point, everyone knows Steve Jobs, one of the best entrepreneurs of all time, was fired from Apple the first time around. And that's how it goes. So there is absolutely a culture of failing fast, innovation, and change. So it's funny, I'm not actually sure what Silicon Valley is, right? If you go back 40 years, Silicon Valley was where chips were made. It was a hardware place. It then became, a software hub, etc. In the 2000s, it became where Facebook was. Now, it's, completely different. But you have that, again, you have that community, to your point. People that go to Silicon Valley, the successful ones, tend to stay and seed the next generation. I think the UK needs to learn how to do that. So learning how to fail quickly, and failure begets success eventually, but also how to recycle not just the capital, but the human capital internally.
Right. Yeah. So these are fantastic thoughts for the end. So fail quickly, be passionate, have spark, and really make it work for us. And I think that's a great way of ending 2024, starting 2025.